Hi, and welcome to Random Rogers Big Picture for the week of July 26th. If you've been with me for a while, then you probably know that I have peculiar ideas on certain things like drinking soda and weird things like that. Also, I've got very I've got off-the-wall theories sometimes that I like to throw out there just as I don't know if I would say as a means of getting a dialogue going, although that would be nice. But in talking about wacky theories, I think it kind of stretches the bounds of the thought process. And while, what I'm going to talk about is not something I would really suggest, maybe it's something to think about in terms of, okay, well, if there's any truth to this whatsoever, maybe it can gauge appropriate risk levels to take, or what type of exposure to volatility you really need or don't need, as the case may be. So, in that context, I had a thought on Friday about, the average bull market, according to John Hussman, goes up 180%. So in a simplistic world, and let's just keep it simple, in a simplistic world, that means that half the bull markets go up more than 180%, and half of them go up less than 180%. Okay, and then Hussman goes on to say that about half of what was gained ends up being given back, and then the next cycle starts. And so I haven't done the math exactly. I'm taking his word for it. It sounds, intuitively close anyway. How about that? So the idea here is, so think about this. Someone who is today 60 years old. Okay, so 10 years ago, they were obviously 50 years old, give or take. 10 years ago, they had just gone through a mega bull market where from 1981 or 2, whenever the bottom was, through the peak, the S&P 500 went from, I think it was up something like 12-fold or something crazy like that. It was just a colossal run. Or if you just want to take it from the 90s, it was a four-bagger going from a little over 300 to the 1,500 that it finally peaked out at in March of 2000. Okay, so chances are, going forward, depending on your age, and so this isn't really going to be potentially applicable to people above a certain age, but there will be another bull market again of a certain size, and in that bull market, the level of the S&P 500 will double or triple, something like that. So if you're 50 and you've been saving diligently, and then you get a 5-year period or a 6-year period where the market does in fact triple, you've been saving diligently all along, getting some sort of middling growth or whatever, and then come 50, you get a double or a triple in your money. From that point forward, regardless of whether you think a bear market is coming around the corner or not, but at that point, does it make sense to take take it off the table? From that point forward, completely redo your asset allocation, so that maybe along the lines of Taleb, something like a 10 or 15%, something small in equities, something not huge, but something meaningful in like commodities, maybe 10%, which is higher than I talk about doing, to be sure, but something meaningful in commodities as an inflation hedge. Although if you've got a triple, you continue to save money. I don't know how much hedge you need, because you're continuing to add to it, and I've never been in the camp of hyperinflation, just potentially uncomfortable inflation is coming our way. But so at that point, and then you have something like 10 or 15% equities, maybe 10% commodities, a whole bunch in tips, a whole bunch in foreign sovereigns, something like that, where you're taking very little, not a whole bunch in foreign sovereigns, maybe like 25% in foreign sovereigns, where your risk profile changes radically, such that you simply are not taking risks. So a 50-year-old might reasonably have $500,000. Someone, and again, this is the assumption here is that they have saved, properly and diligently. Living below your means would always be nice too, wouldn't it? Back to crackpot, or very severe opinions I have. And then all of a sudden, you go on a run where you end up with $1.5 million or $1.2 million or $1.3 million, which in a 5 or 6 year period is not unreasonable. That happens time and again in bull markets. So from that point forward, it introduces the notion of how much game over should come into your thinking. And from there, if you really are saving, and then you get some sort of 4% average growth from that point forward. This is a theory, and so I'm hoping that this will stir up some comments. I've kind of touched on this before, the notion of game over, or people talking about when I get to when the S&P gets back to 1,000 or 900 or 1,200, then I'm getting out. And I remember a specific post where, and I'll try to find it if I can, where I say, well, instead of something like that, why don't you plan on getting out at SPX 3000, which is not impossible in the context of the next normal bull market. That it might triple is not that far beyond normal. And maybe at that point you get out, and regardless of your age. So really the point here is not that you should think in these terms, but maybe think about how much risk do you really need to take. If you're lucky enough to live below your means, if you need a $4,000 a month income need and you've got $2 or $3 million in the bank, well, how much do you really need in equities? You need some, but how much really? I doubt you need a normal 70-30 allocation, but maybe you think you do. All right, that's it. Short post this weekend. Have a good one.